Your retirement plan was built on three assumptions: that stocks go up over time, that bonds protect you when they don't, and that the system underneath both of them works. And right now, all three of those assumptions are being questioned by the same analysts your financial advisor reads. Most retirement plans have no answer for what's coming. Bitcoin does. I'm David. I spent years at the company that secures more Bitcoin than anyone else on the planet, and I help professionals and retirees protect and grow their wealth with Bitcoin. In this video, I'll show you three things: the structural risk inside your retirement portfolio that no traditional product can hedge, why analysts are flagging 2029 as the year three separate pressures arrive at once, and why Bitcoin held in self-custody is one of the few options that stays untouched by what's coming. Let's get into it. Every retirement plan in existence rests on a single assumption that almost no one questions: that when you sell, someone will buy. Here's how the system actually works. During your working years, money flows in. Every paycheck, your contributions buy assets, stocks, bonds, target date funds, automatically on autopilot. Then on the day you retire, the system flips. You stop buying, you start selling. And in theory, that's when the work pays off. But the moment you start selling, the whole thing depends on someone else stepping in to buy at a fair price. And this is the part most retirement plans were never designed to handle. That assumption was reasonable in the 1980s. It's no longer as reliable today. The products you actually own, index funds, target date funds, pension allocations, were built for a world where the buyer was rarely in question. But most of them won't react to a structural shift until it's already in motion. Three forces are converging on the same window of years. The first is passive investing. Roughly half of US equity market value now sits in index funds and target date funds. These funds buy stocks regardless of price. Every payday, money flows in from millions of paychecks, and the algorithm allocates it into the index, indifferent to whether stocks are cheap or expensive. That has driven prices up for 40 years. But the same algorithm runs in reverse during retirement. The fund sells regardless of price, no matter what the market is doing. And here's something most people don't realize. After age 73, the IRS forces retirees to sell. It's called a required minimum distribution. Every year, regardless of market conditions, the retiree must withdraw a minimum amount from their 401k or IRA. And if they don't, the penalty is 25% of what they fail to withdraw. The IRS is many things, but patient is not one of them. So the selling isn't optional, it's mandatory. The system has been running in one direction for 40 years. It's never been stress tested at scale on the way out. The second is demographics. The baby boomer generation, about 65 million people holding around $78 trillion in US assets, is now entering the years when they sell more than they buy. Americans over 70 already hold about a third of all US stocks. The pace of selling accelerates through the late 2020s and peaks in the early 2030s. The third is the buyer behind them. Gen X, Millennials, and Gen Z hold a fraction of that wealth. The average boomer 401k balance is around $270,000. Gen X, about $220,000. And Millennials, under $90,000. And they invest the same way, through index funds and target date funds. So when boomers sell, the buyers on the other side are the same algorithms, buying mechanically with smaller paychecks from fewer people, just as automatic as the sellers and a fraction of the size. That convergence is what 2029 represents. Not a prediction, a window when the largest selling cohort in history meets the most mechanical buying system ever built, while the next generation can't take the other side at current prices. The retirement system has no answer for this. It was built when buyers were assumed. And here's what that could mean. In a normal recession, the S&P falls 30, maybe 40%. In 2008, peak to trough, it fell 57%. But those happen in markets with active buyers on the other side, picking up bargains. The next major drawdown won't have that. When the algorithm sells and there's no thoughtful capital stepping in, the floor doesn't hold. A retiree who watches half their portfolio disappear in their first year of withdrawals doesn't get those years back. And the rules force them to keep selling anyway. That's the buyer side. If you're already thinking about how to protect your wealth from this, the link in the description is where to start. We'll come back to Bitcoin shortly, but the buyer problem is only half the story. The bond side of your portfolio has been quietly failing too. If your stocks are exposed to the buyer problem, every financial advisor has the same answer. The bond side, the supposedly safe half of your portfolio. And this is where the math actually catches up with you. Here's how it was supposed to work. 60% in stocks, 40% in bonds. When stocks fall in a recession, central banks cut interest rates. When rates fall, bond prices rise. So in a downturn, bonds gain value while stocks lose value. The two halves cancel each other out. Your wealth stays relatively stable. That's the deal you signed up for nearly 40 years, from 1982 to about 2020. It worked. Every time stocks fell, bonds rose. The cushion held. But the cushion isn't holding anymore. And in 2022, every retiree in America found out the hard way. Inflation hit 40-year highs, and the Federal Reserve had to raise rates aggressively to fight it. Here's why that matters for bonds. If you own a bond paying 2% and new bonds start paying 5%, nobody wants to buy your old bond at full price. So when the Fed raised rates, every existing bond in every retirement portfolio dropped in value. Bonds had their worst year in modern history. The S&P 500 fell roughly 19%. Long-term bonds fell over 30%. The two halves that were supposed to move in opposite directions fell together. For a 30-year-old, that's a setback. For a 65-year-old who started drawing down the same year, it was a permanent loss. They sold equities while they were down, and the bonds they were supposed to lean on were down too. So why did this happen, and why won't it stop? The answer is something economists call financial repression. Governments now hold so much debt that they cannot afford to pay real interest rates above inflation. The cost would bankrupt them. So they keep yields suppressed, below inflation year after year. The cost gets quietly transferred from the borrower, the government, to the saver, you. And by quietly, I mean nobody sends you a letter explaining that your bonds are now a charity for the Treasury. Which means the bond half of your portfolio is now doing the opposite of its job. It's losing real value every year you hold it, while waiting for a stock market crisis where it may not even act as a cushion. The retiree pays twice, once in real returns, again in a crisis. The 60-40 isn't broken because someone tampered with it, it's broken because governments spent decades borrowing more than they could afford to pay back at honest interest rates. And until that changes, the cushion isn't coming back. So the question becomes, if the buyer is uncertain and the bond side is broken, where does that leave a retiree? And that's where Bitcoin actually enters the picture. And not in the way most people think. Here's the part that's actually predictable. If a real shock hits the retirement system, passive flows turn. The bond side fails to absorb it, asset prices fall. Most people assume cash becomes king. For a few months maybe, not for long. Look at the historical pattern. 2008, bailouts and quantitative easing. 2020, roughly 40% of all dollars in existence were created in 2 years. Every major crisis since 1971 has been met with the same response. Lower rates, print money, devalue the currency to keep the system functioning. There is no political universe in which a generation of more than 60 million retirees watches their savings collapse and the government does nothing. The response is almost mechanical. And the asset class designed to absorb exactly that response, currency debasement, is the one with a fixed supply that no central bank controls. Bitcoin's role in a retirement portfolio is unusual. In the melt-up before a crisis, Bitcoin rises with risk assets. In a sharp crash, Bitcoin can fall hard. It's not a shock absorber. Anyone who tells you Bitcoin goes up the day the market goes down is selling you something. But in the response that follows, the printing, the debasement, the flight to fixed supply, that's when Bitcoin's design does what it was built to do. And here's the piece nothing else gives you. Bitcoin held in self-custody on a device you control with keys nobody else holds has no counterparty. No fund manager, no custodian, no broker between you and the asset. For something designed to hedge against the system, holding it inside the system defeats the point. How much you hold depends on where you are. A retiree drawing down should hold a defensive position, small but real. Someone still in their accumulation years with a longer time horizon can build a meaningful position over time. The asset is the same. The sizing is personal. What matters is that the position exists at all and that you know how to hold it correctly. If you want to learn how, the link in the description is where to start. Now, if you want to understand Bitcoin's growth and what it can mean for your wealth in the coming years, without the ridiculous predictions, I've crunched the numbers for you in this video here.